A small office in downtown San Rafael, California. The summer of 1956. The fog is still in the eucalyptus. Inside the building, two men sit at a folding table. The first is in his early 30s, an engineer. He has a soft jaw, a clean shave, and a fountain pen he keeps in the pocket of a short-sleeved shirt. His name is Bill Fair. The second is a year older, a mathematician. His name is Earl Isaac. Between them, on the table, sits a wooden tray of punch cards, several hundred of them, on loan from a small finance company. Each card is a person, a name, an address, an age, an income, an employer, the date a loan was issued, and whether the loan was paid back. What they do not yet know, what no one in that room can know, is that the small statistical formula they are about to write down will, within a single human lifetime, decide who in the United States is allowed to own a home. This is the story of how the most consequential algorithm of the 20th century was invented by two men in a borrowed office, sold for a few $100s a month, and then quietly placed beyond the reach of every court that ever tried to look inside it.
This video is based primarily on Frank Pasquale's The Black Box Society, Cathy O'Neill's Weapons of Math Destruction, Solon, Barocas, and Andrew Selbst's Big Data's Disparate Impact, Fair Isaac Corporation Filings and Corporate History, the text of the 1974 Equal Credit Opportunity Act, the 1992 Federal Reserve Bank of Boston study on mortgage lending, and the United States Supreme Court opinion in Watson versus Fort Worth Bank and Trust.
To understand what Fair and Isaac built, you have to understand what existed before them. In 1955, if you wanted to buy a refrigerator, you walked into a department store and asked. A man at a desk, and he was always a man, would look at your suit, listen to your voice, ask after your wife, decide whether you seemed like the sort of person who paid his bills. He would write a number on a card. He would slide the card to a clerk. The clerk would either bring you the refrigerator or send you home. This was called credit judgment. There was no formula. There were habits. There were neighborhoods that the man at the desk had been told not to lend in. There were last names he had been told to refuse. There were faces. By the middle of the 1950s, the United States held tens of billions of dollars in outstanding consumer credit. The man at the desk could no longer keep up. Bill Fair and Earl Isaac met at the Stanford Research Institute, an applied science consultancy in Menlo Park that took commercial contracts and produced technical reports. They had each spent the war working on problems that involved very large numbers and very small certainties. After the war, they began to apply the same methods to the small problem of whether a stranger would repay $68. They left SRI in the summer of 1956. They printed business cards. They named the firm Fair, Isaac and Company. The first commercial contract was modest. A finance company called American Investments. A few hundred files. Fair and Isaac took the files apart
The first model worked. This is the second thing you have to understand. It worked. In repeated tests, The formula predicted repayment better than the man at the desk. Not by a little, by a great deal. The man at the desk, it turned out, had been wrong far more often than anyone had cared to measure. In the trade press of the late 1950s, there are no headlines about this. It is not a scandal.
It is a piece of office equipment. A finance company in St. Louis tells a finance company in Cleveland. A finance company in Cleveland tells a department store in Chicago. By the early 1960s, Fair Isaac has clients in 11 states. By the end of the decade, Montgomery Ward. By the early 1970s, Sears. By the middle of the 1970s, almost every major commercial bank in California. The score does not yet have a name. It is simply called a score.
The 1970s are the decade in which the formula stops being a curiosity and starts being a country. Three things happen at once. First, the consumer credit market doubles, and then doubles again, and the human credit manager becomes economically impossible. A bank cannot pay a man in a green visor to look at 1 million applications a year. The score is faster. The score does not eat.
Second, the federal government discovers, with some alarm, that the man at the desk has been making decisions on the basis of race, sex, and national origin. In 1974, Congress passes the Equal Credit Opportunity Act. It becomes illegal that year to deny credit because the applicant is a woman, or black, or Mexican, or Catholic, or 30 years old and unmarried. The act is necessary. Until 1974, a married woman in the United States could not, in most states, obtain a credit card in her own name. A divorced woman, however solvent, was a category of person to whom credit was simply not extended. The act is also a problem for the banks. They must now prove that their lending decisions are objective. They must produce, in writing, a defensible reason for every denial. Fair Isaac is the system already waiting.
The score is objective in the way a thermometer is objective. It produces the same number every time. It does not know if the applicant is a woman. It does not know if the applicant is black. Officially. Third, in the same decade, the number begins to gate more and more decisions. It begins as a tool for retail credit. Then it gates auto loans. Then revolving credit. Then mortgages. Then apartments. Then employment. Then car insurance. Then health insurance. Then, in the slow furniture of the next 30 years, almost every transaction in American life in which one party gives something to the other party on the assumption that the other party will pay it back. The score. The same number. The same formula. The same weighted table of attributes, refined and refined and refined again, until in 1989, Fair Isaac releases the version of the model that becomes universal. It produces a number between 300 and 850.
They call it the FICO score. For a time, in the late 1980s, almost no consumer in America has ever seen their own score. It is a number that lenders see about you. It is not a number you are entitled to know. By the end of the century, the score has become the single most consequential data point about the average American. More consequential than blood pressure, than salary, than education, than zip code, because it determines whether the other data points are allowed to translate into a house. And then,
But there is a problem.
the algorithm did not invent its own judgment. It learned its judgment. And what it learned from the people it was built to replace. Here is the difficulty that nobody at the folding table in San Rafael in 1956 had thought to write down. The model is trained on history. History, in this case, is a stack of several hundred punch cards from a finance company in the Midwest. And after that, 1 million files from finance houses across the country. And after that, the loan books of every bank in California. And after that, by the 1980s, hundreds of millions of records from every consumer transaction in the country. The history records who repaid and who did not. The history does not record who was allowed to borrow. For the entire period from which the training data is drawn, from the 1920s through the 1960s, Black Americans were systematically refused mortgages by their own government. The Homeowners Loan Corporation, founded in 1933, drew red lines around their neighborhoods on actual maps. Banks declined to lend inside the red lines. The Federal Housing Administration, founded in 1934, refused to insure mortgages in black neighborhoods for 30 years.
A statistical model trained on the loan history of the United States is therefore a statistical model trained on the consequences of redlining. It will conclude, correctly given its data, that certain zip codes are associated with elevated default risk. It will not know that the elevated default risk is a consequence of having been redlined. The Equal Credit Opportunity Act forbade the use of race as an input. It did not forbid, because no one in 1974 had imagined it possible, the use of inputs that perfectly tracked race. In October 1992, 4 economists at the Federal Reserve Bank of Boston published a study of mortgage applications in the Boston metropolitan area. They examined more than 3,000 applications. They controlled for credit history. They controlled for income. They controlled for employment. They controlled for the size of the loan and the value of the property.
There is a second difficulty. Even if a plaintiff suspects that an algorithm has denied her unfairly, she cannot, in most cases, see inside the algorithm. The formula is a trade secret. In 1988,
the United States Supreme Court decided Watson versus Fort Worth Bank and Trust. Clara Watson was a black bank teller who had been passed over 4 times for promotion in favor of white candidates. The bank had no written promotion criteria. The court held that the disparate impact framework, under which a plaintiff could challenge a facially neutral practice that fell more heavily on a protected class, applied to subjective decisions of this kind. Watson opened the door. Plaintiffs began through the late 1980s and the
to bring disparate impact claims against lenders. They almost always lost. They lost not on the merits, but on the discovery. The scoring formula was the property of Fair Isaac, or of one of the credit bureaus, or of the bank's own modeling division. It was protected as a trade secret. A plaintiff could not subpoena the math. You could be told you had been denied. You could not be told why. By the 2010s, the original FICO model has been superseded in much of the industry by machine learning successors. The new models do not use 30 variables. They use thousands. They are trained on browsing history, on purchasing history, on the density of a person's social network, on the exact rhythm with which a user types her own name into a form. The new models are not auditable, in the way the old models were not auditable. The new models are not auditable in a deeper sense. Even the engineers who train them cannot, after training, fully explain which inputs are driving any given decision. In 2016, the legal scholars Solon, Barocas, and Andrew Selbst published a paper called Big Data's Disparate Impact. They demonstrated with mathematical clarity that an algorithm can learn to discriminate on the basis of race even when race is not in the training data. Even when every obvious proxy for race has been removed. Even when every effort has been made to scrub the data of any feature correlated with race. Because in a sufficiently rich data set, race will reconstruct itself out of combinations. In 2019, Goldman Sachs, then issuing the Apple Card, was investigated by the New York State Department of Financial Services after several customers reported that the card had offered them credit limits many times higher than their wives, for the same address, the same income, the same tax return. The investigation closed in 2021. The regulator found no statutory violation. It also noted that the bank could not explain how the algorithm had reached its decisions. In 2022, the Consumer Financial Protection Bureau issued guidance instructing lenders that an adverse action notice citing the output of a complex algorithm did not satisfy the federal requirement to provide specific reasons for a denial. The lenders are still working out what to do about this. The score, in some form, continues to gate roughly 90% of consumer credit decisions in the United States. It also gates a growing share of apartment rentals. Several states have moved in the last 5 years to restrict the use of credit scores in tenant screening. Most have not. It gates car insurance in 46 states. It gates in many jurisdictions
certain categories of employment. It is the closest thing the United States has, at the time of this recording, to a national identity number that no one voted for.
Bill Fair died in 1996. He was 74. Earl Isaac died in 1983. He was 62. The company they founded is today called FICO. Its stock trades on the New York Stock Exchange under the ticker symbol FICO. Its annual revenue, at the time of this recording, exceeds $1.5 billion. The original office in San Rafael, the small building where two men sat at a folding table in the summer of 1956, no longer functions as anything in particular. There is no plaque. Of the few hundred punch cards on loan from the Midwestern Finance Company, none survive. The cards were destroyed in the ordinary course of business after the data on them had been transferred to magnetic tape. The magnetic tape is also gone. What remains is the method. The method has been refined 10,000 times. It has been bought, sold, regulated, deregulated, sued, settled, scrubbed, reweighted, and re-released under dozens of names. Its descendants now sit inside lending platforms, credit bureaus, insurance underwriters, landlord screening services, employment screeners, and the underwriting engines of a generation of fintech companies founded by people who have never heard the names Fair or Isaac. In the hour during which you have watched this video, those descendants have, by a conservative estimate, evaluated more than 2 million Americans. Some have been told no. A small number have been told the reason.